Hello, everybody. Welcome to the FIASI meeting with Bloomberg Intelligence. I'm Ralph DeCesar, the FIASI board member and the past president. Before we get started with Bloomberg, I'd like to remind everybody about our annual Sustainable Finance Conference to be held May 1st live at Fordham University's Lincoln Center campus. More info is available at www.fiasi.org. Now I'd like to turn it over to your host, Robert Schiffman of Bloomberg Intelligence.
Hey, Ralph, thank you so much. Appreciate everyone at FIASI tuning in. I know that schedules are busy. There's a ton going on in fixed income markets. So we really appreciate the time. This has become a regular annual event for us, and we always look forward to it. So today, we've got a big lineup for you. I'll talk very briefly about, for those of you who don't know what BI credit research is, and then I'll turn it over to our analyst team. We've got analysts across sectors and regions that will really be able to go over what's going on in their spaces, whether or not rate cuts or non-rate cuts or issuance is going to be affecting their world, what bottoms-up analysis is the most impactful, and names they like and don't like. We'll pretty much be hitting on every sector, so buckle your seatbelts. For those of you that don't know about BI, I think at this point we've been around 10 plus years, and people are really starting to understand what we're doing. But we've got a few hundred professionals covering a couple of thousand credits across securities, whether it's credit, equities, rates, commodities, ESG, and we're pretty much covering every major sector that's out there. And we have specialty groups as well, like our litigation team, that whenever there's something going on, whether it's a lawsuit or a merger potentially closing, we've got people in courtrooms that do this every day for their lives to figure out from the legal aspect how that's going to impact valuation, credit quality, and equity quality. So there's a ton of resources for you here. The beauty about Bloomberg is that unlike the sell side, there are no Chinese walls. So we work very closely with all our counterparts, credit analysts and equity analysts. We writing reports together, doing webinars together, going out on the road together. And one of the best things is that we're accessible. If you need us, whether or not you're a terminal user or not, and at the end, I'll share all of our emails, we're always here. We're happy to talk. We want to talk. That's what we do for a living. We love to give our opinion, right, wrong, or indifferent. The special thing that we have is that we have the Bloomberg terminal. So we can take a lot of our research and tie it into terminal functionality, which enables you to not just see what we're doing, but to update your own research and make it bespoke. If we produce things such as an FIW chart that will give you spread levels across a curve, when you click on it, it'll open up live levels. So we go beyond just traditional research, but we layer on top everything that the terminal has to offer. I think it's a power across the board, from the people that we have to the companies that we're covering to the subsectors, and across all the genres. It's just something I don't think you can get anywhere else. And I'm really excited to have our team present today. Again, we're going to be going over a lot of different things. At the end, we'll make sure all these slides are available to Ralph and Lauren so that if anyone wants them, they can get a copy. So without a further ado, I don't think you could spend a second in any of our seats without understanding what's going on in financials. So we'll start off with our financials team and Arnold Kakuda. Arnold.
Great. Thanks, Rob. So let's start off talking about M&A. M&A, we think, is going to be up this year from a very anemic pace last year, right? And so within that, for bond investors, that could present some risk. And we think that bank bonds actually have less M&A risk, and that we've seen some mega deals this year, right? Already above 25 billion, like CAF One, announcing the acquisition of Discover, which my colleague Himanshu will talk about later. But that's all equity financed, and that's pretty typical in the bank space. We also saw another one in the energy space, Diamondback, which was also quite credit friendly, 70% equity finance, but there was still a bond component, and we've seen some pretty big bond deals come to market, so far to finance M&A, but in terms of potential future deals, we think more and more of those might be more debt financed. So I'm making the case here for bank financials, understanding that yes, NYCB, we think that represents a shift in the concerns this year to asset quality. Of course, NYCB had some great news yesterday, right? But we think the concerns in bankland have shifted this year to asset quality from interest rates. And we think the banks are actually better prepared this year for three key reasons. First is valuations are better than last year, and then secondly, there's annual stress testing, and then thirdly, we think the factor that helps is capital levels are up versus last year. So if we turn to the next slide, let's delve into valuation on the next slide. Okay. Is there another slide, Rob? Okay, I guess. Okay. Well, okay. So in terms of valuation, the banks are actually the financials trade about 6-7 basis points wider than the overall corporate bond index right now. But if you go back to 2021, they were 10 tighter, right? So in terms of the valuation, we still think that bank financials are still pretty cheap compared to the overall index. And then on the annual stress testing, right? If the regulator feels like there's something amiss with the bank, it can raise capital requirements, or in this case, what we see on the screen here, Wells Fargo actually had to cut its dividend 80% in 2020. Right, so the annual stress testing we think is a check on how the banks are doing. Every year CRE is a concern this year. Well, for the annual stress test, the CRE portfolios of all these banks are haircut 40%. So these are the live tests that these big banks have to go through every year, right? And so in terms of the asset quality concerns this year, we feel like the annual stress testing does help. So if we turn to the next slide. Compared to last year, the capital levels are up a lot. Part of that is the capital conservatism. There's new regulation coming on board called Basel Endgame, and that's made banks really conservative on capital returns. And so they're really, even though they're making very good profits right now, the share buybacks and have been very anemic, and they're retaining more and more capital. So, compared to last year, they're starting off in a better place, even if some of these CRE concerns that people have manifest. Turn to the next slide. Some of the two names that we think will that might be interesting. One of them, the first one is B of A. As you can see on the slide here, B of A in the red, their annual stress testing results, their loan losses on these stress tests are actually lower than all its peers. Yet, its bonds trade about 10 basis points wider than similarly rated JP Morgan. So, right, if these concerns shift this year to asset quality on loan losses, CRE, whatnot, we think B of A might have time to shine this year. And plus, they've been very active bond issuers, but we think some of that negative technical might go away this year in terms of we feel like peers Wells Fargo and JP Morgan might be more active on that front. Turning to the next slide. Here we look at the valuation of U.S. Bancorp. Basically U.S. Bancorp used to be top gun, but it's no longer getting that loving feeling anymore. It used to be the highest rated as well as the tightest trading of all big U.S. banks, but now it's in the white line. It's actually trading a little bit wider than and lower rated P&C. And so we think that the bank will continue to be conservative on capital returns, increase capital levels. about 20, 25 basis points every quarter. And that'll help it regain its higher standing within the bank relative value. And with that, I'll turn it over to my colleague, Himanshu Bakshi.
Thank you, Arnold. Good afternoon. Thank you for joining us today. My name is Himanshu, and I'm a credit analyst in BI, and I cover US financials and global banks. So today I will be talking about proposed acquisition of Discover Financial by Capital One. So just to give you some background, on Feb 19, Capital One announced the acquisition of Discover in an all-stock deal valued at about $35 billion. The combination will create the largest US credit card lender by volume and sixth largest bank by assets. And the deal is expected to close in late 2024 or early next year. Now, BI's litigation team thinks that the deal will face intense antitrust review by the Department of Justice, because even though the DOJ may like more competition for Visa and MasterCard because it will lower fees for consumers, the two lenders tend to issue credit to underserved sets of consumers, and more so than most rivals. And the DOJ can argue that the deal could substantially lessen competition in that space. So the two banks, Capital One and Discover, must convince the DOJ that underserved borrowers won't face fewer choices or higher rates. Next slide, please. As you can see from this chart, Capital One has a higher exposure to subprime borrowers than peers, with 32% of the bank's domestic card lending going to customers with FICO scores below 660. However, with the acquisition of Discover, the overall quality of Capital One's card portfolio will improve, as Discover is mainly a prime lender, with just 18% of its card portfolio having a FICO score under 660. Next slide, please. Now, looking at the asset quality, though Capital One's domestic card credit metrics are now above pre-pandemic levels, delinquencies have been stabilizing for a while, and the net charge-offs rate is settling about 15% above 2019 levels, which is encouraging from an asset quality standpoint. And the bank's ratio of allowance for credit losses was about 7.6%, which is a healthy level in our view. Next slide. Now, looking at Discover's asset quality, the net charge-off rate on Discover's credit card portfolio has actually increased faster than we expected. And this was because of Discover's decision to briefly expand its credit exposure to include near-prime customers back in 2022. Now, Discover expects net charge-off rate in 2024 of about 4.9 to 5.3%. That will be highest in at least a decade, and closer to peer Synchrony Financial, which underwrites to a loss rate of 5.5 to 6%. And Discover's loss reserve ratio stands at 7.2%, which is also a healthy level, we believe. So overall, we think the combined entity will have a better asset quality than Capital One. Next slide, please. Now, the pro forma C2 capital ratio for the combined entity is expected to be a strong 13.9% at the close, which will be higher than Synchrony Financial at 12.2% and American Express at 10.5%. Next slide. So as of today, the median credit rating of Capital One is high BBB and Discover's is mid BBB. Now, after the announcement of the acquisition, S&P and Fitch affirmed the credit ratings of Capital One and placed Discover's rating on positive watch, which was in line with expectation. Moody's, however, placed Capital One's rating on review for downgrade and Discover's rating on review with direction uncertain. And Moody's said there are three possible outcomes. If the first one is if the transaction fails, Moody's may downgrade Discover. And if the transaction is complete, Discover may be upgraded and Capital One's ratings may be confirmed. Or Capital One's ratings may be downgraded and Discover's rating may be confirmed. Anyways, assuming the worst case scenario, even if Moody's downgrade Capital One, the median credit rating of the combined entity will be mid-BBB. Next slide, please. So to conclude, we expect the transaction could lead to a rating upgrade and tightening of Discover's bonds, which trade wider than Capital One. And with that, thank you. I will pass it on to Jody.
Thank you, Himanshu. I'll kick off the consumer segment. I cover leisure, lodging, gaming, restaurants, and rental car companies, all these sort of fun sectors, particularly during COVID. So we did a survey at the end of December on the state of U.S. travel. It was our first ever in the area of the world, or in the U.S. general population. So our screener question, which captured almost 3,500 people across the United States, in which people could choose more than one option, showed that just as many people are prioritizing vacation in 2024 as they are buying a new car at 28%. And that's surpassing those who plan on buying a new house at 19% this year. Next slide, please. So if we drill down to that 28% on the prior side, which is roughly 1,000 people, we will see that 67% of the US vacationers plan to spend more in 2024 than 2023. And if costs exceed budget, well, 45% plan on increasing their budget versus only 25% that plan to cut back on activities. Next slide, please. This bodes well for high yield leisure in particular, which we don't believe will see the robust 25% return that we saw last year, but it may still have room to run. So next slide, please. Which you can see with the credit spreads. The high yield leisure index, which is 2/3 of which is cruise line debt, could narrow further this year towards related sectors under our coverage. And this compares to, for example, high yield gaming, which is in its tightest level in quite some time and may have uneven performance this year, depending on regional US or Vegas or Macau exposure. Next slide, please. So let's drill down into that 2/3 of high yield leisure. Major cruise lines communicated solid booking levels this year during the wave season so far. So this implies more solid sources of cash. And Royal Caribbean and Carnival, we believe, are working towards investment grade goals of 2025 and 2026, respectively. But Norwegian is in that rising tide lifts all boats categories, no pun intended. It is benefiting from this momentum despite a larger debt load this year, despite management's history of missing deleveraging targets, and despite its customer base making it more difficult to complete further cost cutting. Next slide, please. Yet really it's Hertz and Avis that we see as having situations that get worse before they get better. And we'd like to describe this as a cost problem, not a revenue one. Hertz on the left-hand side chart it boosted its electric vehicle presence, and this year it's exiting about 1/3 of that fleet. We expect weaker margins and cash flow from effects of defleeting, while secondary EV markets remain more uncertain. Avis is also defleeting after delayed shipments of vehicles from OEMs. As the chart on the right shows, along with Hertz, Avis has increased its exposure to risk vehicles over program vehicles over the past few years, thereby exposing itself to shrinking equity cushion on its fleet as used car prices come down from the peak. Next slide, please. Finally, for our broader leisure sector, the Bloomberg Terminal MODL screen shows EBITDA margins that are either nearing or meeting 2019 levels for most of our companies. Leverage has improved for many, but some are still working towards pre-pandemic levels, while cash flow projections are robust. We therefore expect different approaches by management teams, as we already saw with Choice's push for Wyndham, the pending merger of Six Flags and Cedar Fair, and Sands' shift back to shareholder rewards now that it's investment grade once again. CapEx, share buybacks, and M&A could all play a role this year, as we saw Arnold talk about and Himanshu talk about. And with that, I will turn the call over to Julie Hung.
Thanks, Jody. Hi, my name is Julie Hung, and I cover the consumer staples sector. If you look at this chart, you could see that consumer sentiment is improving. We heard at CAGNY, and we are hearing over the past couple of days, like with earnings reports, that companies are seeing the same trend. If and as rates are cut, cheaper borrowing, increased disposable income, increased asset values could all encourage spending. So this could help our consumer products companies with more exposure to discretionary products such as Spectrum brands and Newell brands. Next slide, please. Food inflation trends have been moderating, which is another message that we've heard from our food and beverage companies. Commodity costs and supply chain issues have improved from a year ago, with food and beverage companies expecting price increases to moderate as food inflation slows down. We expect to see some better volume after 3 consecutive years of volume declines, helped by a lower pace of price increases and a more stable macro environment. We're hearing that consumers are stretching their grocery store visits, eating through the freezer and pantry because of higher household costs. But with lower interest rates and possibly higher disposable income, we could see more volume improvement at the food and beverage companies. Next slide, please. You could see that consumer staples companies have been focused on healthier balance sheets. This is a result of what happened during COVID. Like, they don't want to get caught with a headwind that takes them out of the blue. We've seen consumer staples companies focusing on reducing debt, generating cash flow, and improving EBITDA to help reach net leverage targets. Shareholder returns have been done within the parameters of a balanced capital allocation policy. And this focus on healthy balance sheets can continue to help consumer staples manage through headwinds, including the headline volatility around the use of diet drugs. Next slide, please. This shows M&A activity, 2002 versus 2023. So at CAGNY, which was the annual consumer conference in mid-February, the big message on M&A is a focus on tuck-in acquisitions. While companies are not against larger acquisitions, because of the higher cost of financing over the past few years and a lack of good deals out there, there hasn't been a lot of larger M&A activity. However, even with lower financing costs, the key theme is to focus on smaller tuck-in acquisitions and nothing that will stress the balance sheet. So M&A in 2023 was down 53% from 2022, and so far in the first quarter, M&A is down 69% from the first quarter 23. Next slide, please. These are our overall picks and pans, and you can find this on the BI dashboard and the idea generation tab. While spreads are overall tight in the consumer staples sector, we do see some opportunities within the consumer staples space. I'll just highlight a couple of names. Coty is a high yield name that we believe is on its way to investment grade, given the company's EBITDA momentum in the premium cosmetics and fragrance space, and its focus on getting to a net leverage target that is indicative of an investment grade credit profile. On the other side, Tyson and JBS, we feel that their spreads could widen given the uncertainties in the protein space. However, we do note that both companies are focused on a healthy credit profile and net leverage ratio. But with EBITDA volatility, it could take longer than expected. And with that, I'll pass it over to our retail analyst, Mike Campellone.
Thanks, Julie. My name is Mike Campellone, and I cover investment grade and high yield retail for our US BI credit team. So zooming out to some of the macro elements we've seen recently, while margin pressure from elevated supply chain costs has eased for most of the US retailers that we cover, high inflation and the resumption of US student loan repayments has pressured various cohorts of the US consumer, especially lower income consumers. For most of last year and continuing into this year, the result's been a pullback in retail spending as consumers both, one, prioritize spending on experiences, and then two, have been more increasingly selective in what they buy. So here, just looking at some alternative data sets that we've been tracking, consumers, are altering their behavior amid record high inflation. Like I said earlier, here we looked at monthly U.S. credit card transaction data that's broken out by spending category. So while consumer spending remained strong in 2023, it was largely driven by experience-related categories like leisure, travel, and dining, and away from goods. In recent months, we've seen U.S. consumers start to pull back on that experience-related spending. So looking back at the themes we pointed to a year ago and how they track throughout the year, the first being retailer inventories realigning, the second being cost pressures easing, especially for freight, and then third being a rebound for some of the weakest retail subsectors over the past 2 years. And I'll dive into each of these themes a little bit more now. Next slide, please. So here you'll see some charts on retailer inventory levels. The left is going to show you year-over-year percent change in aggregate inventory for both investment grade retailers and high yield retailers. The right-hand side will show you some of the single name outliers holding more inventory than their peers. So overall, retailers have made significant progress in reducing inventory levels from their peaks in 2022. But we believe there's still pockets of retail subsectors and companies where inventory levels may need to fall in order to align with weakening demand. These include discretionary categories like apparel and footwear, and also categories who we saw well above average spending levels in 2021 and 2022. So home, jewelry, and sporting goods. Next slide, please. Here you'll see a chart that we created actually back in December displaying consensus expectations for sales and EBIT growth across the retailers we track for this most recent fiscal year. So expectations for the earnings cycle we're currently in the middle of right now. From a margin standpoint, we expect retailers in 2024 will finally benefit from lower shipping and container rates after renegotiating annual shipping container contracts at much more favorable terms. And this typically occurs during the spring season. Next slide. And then moving on to relative value, year to date, the Bloomberg US Dollar IG Retail Index has underperformed the Bloomberg High Grade Index on an excess return basis, while the High Yield Retail Index has significantly outperformed the Bloomberg High Yield Index. At the company level, in terms of relative value, we see positive catalysts for issuers, including Target, Macy's, Dollar Tree, and Albertsons. And on the other end of the spectrum, we see negative catalysts for issuers such as Under Armour, Kohl's, and Dollar General. And right now, I'll turn it over to my colleague, Mike Holland.
Thank you, Mike. Good afternoon, everybody. I'm Mike Holland, Senior Healthcare Credit Analyst covering credits across high grade and high yield. It's been a particularly stressful year. 2023 was a particularly stressful year, and we're still dealing with some of that stress into 2024. If we can switch to the next slide. Put this in here to show spreads over time, give you some context on sort of the healthcare space. Over the past decade or so, spread volatility across the healthcare sector has been particularly pronounced, but generally driven by political and regulatory changes, and that's something that holds true today. If you go back to on the beginning of the chart, you can see between 2012 and 2015, the industry really benefited from unchecked drug price increases and rising hospital charges on the tail of Obamacare being passed. And that was paid for in large part by rising commercial health insurance premiums and deductibles. Those trends really came to an end in 2015. Coincidentally, around the time that Hillary Clinton was tweeting about Martin Shkreli and Valiant's drug pricing tactics. Spreads really gapped out as over-leveraged, large issuers like Valiant and the hospital operator, Community Health, fallen into distress. After rallying through 2018, spreads were gapping out, moving wider until COVID came along. COVID had pronounced impact on the provider space, among others. But while advance payments and liquidity infusions by the federal government brought spreads to record heights in the end of 2020 and the beginning of 2021, those liquidity benefits are running out. They've run dry, and we've seen a lot of negative rating trends across the sector in 2023 and into 2024. High defaults in the sector, and really a function of higher labor costs and higher interest costs, namely for floating rate debt on the loan side. And that pressure is still there for these credits, particularly on the provider side, like air medical transport, physician practice management groups, and the weaker hospital operators. With that being said, the top three sector risks that we've been discussing a lot with clients lately have been the following. First, and foremost is legislative and regulatory risk. There's no shortage of the risk across the healthcare sector today, from Medicare Advantage pressures, the balance billing and the No Surprises Act, PBM transparency, Medicaid redeterminations, which have impacted some companies, but have been handled fairly well thus far. Obviously, the FTC has perked up its head. It's been on the headlines lately with United Health, and as well, we've got this political presidential election this year, which could generate a little more headline risk. Other sector risks, cyber attacks. This is top of mind right now. UNH bought Change Healthcare a year ago, and Change basically think about the pipes of the healthcare system. So data that's being shipped for prior authorization purposes or payments have been gummed up after United exposed that they were under hacking attack. And it's still early stages there, so we'll see how that plays out. But there have been delays in collections and care, so that's something we're keeping our eye on. We think this could really pose a risk to many of the operators that are operating on real thin cash flow margins out there today. And the cyber attack too, I think, could play a role in the Justice Department's antitrust suit against UNH going forward. But again, it's still in the early stages. The third topic that we can't stop talking about is GLP-1s. These new weight loss drugs are, threatening to really increase spending across the healthcare space. There's been a reason why insurance companies, which historically didn't ask, it didn't cover weight loss management, and it seems like the manufacturers are effectively pushing for coverage. And over time, if commercial insurers get involved and employers cover this, it will be a game changer, and it will have long, far-reaching implications across the space, including companies like DaVita and Fresenius, which do kidney care or CPAP devices. There's a lot of positive outcomes that GLP-1s could have on people for patients that would impact some companies that we have under coverage. Next slide, please. Looking at high grade. With high grade healthcare trading around 125 basis points, the resilience of the space remains true as pharma biotechs grow larger, even in the face of pricing pressure as a result of the IRA and other pushbacks by the government. M&A, it's obviously a big part of the space on the pharma side, also on the payer side, backfill, but on the pharma side, the backfill patent expiries, while payer spreads remain pretty tight, even as rising MLRs. And medical loss ratios are basically what the insurance companies pay out. That number's been increasing, and GLP-1s and other service offerings that these insurance companies are offering will continue to drive those MLRs higher in our view. It could be an intermediate term negative. Moving on to high yield. The next slide, please. Here's a chart showing all the high yield healthcare bonds in Bloomberg's corporate high yield index. High yield healthcare has definitely experienced ratings deterioration over the past 2 years, in large part due to, again, rising interest rates as well as labor costs. While labor cost growth is moderated, the cumulative increase is going to keep pressure on cash flows. Looking at some of the names here, we mentioned earlier physician practice management groups and Air Medical Transport. Those are the three companies that are trading at cents in the dollar here. Air Medical, Envision, and Cano Health are all going through restructurings. Bausch Health, one of the biggest issuers in the high yield healthcare universe, is still trading at distress levels as they undergo their metamorphosis, and Community Health is back. And so Community Health and Bausch really are pulling the spreads for the high yield sector wider. In terms of positives, we're seeing a lot of growth continue on the outpatient side. So surgeries traveling to the outpatient. So getting a heart valve replacement in the physician office versus the inpatient facility is much cheaper, and that trend's been favorable to companies like HCA that have invested on the outpatient side, as well as Surgery Partners. Another area that we are keyed in on is behavioral health. Acadia Healthcare has really benefited from destigmatization of mental health care, so they continue to grow 10% plus. And if you have any further questions, feel free to reach out to me directly. Thanks for your attention, and with that, I'll pass to Spencer Cutter.
Thanks, Mike. Hi, I'm Spencer Cutter. I'm a senior credit analyst with BI, covering primarily the North American energy sector, including the independent oil and gas producers, oil field services, and midstream segments. I'll jump right in on the first slide here. It feels like leverage ratios may have bottomed at some point last year and likely to climb higher from here as producers struggle with sub $2 natural gas prices. Oil field services companies are struggling with stagnant drilling activity. and just about everybody who's generating free cash flow is using it to pay dividends and buy back stock rather than pay down debt. Yet with that, credit spreads continue to tighten and have hit some historical levels in February. The spread on the Bloomberg Investment Grade Energy Index fell to 96 basis points last month, only 6 basis points away from the 90 basis points reached in 2014. After that, you've got to go back to 2005 and 2006 to see when spreads were that tight. Dynamics in the high yield market are even more dramatic, with spreads on the Bloomberg High Yield Energy Index hitting a 17-year low last month. On the next slide, one area I thought would be worth highlighting is the high yield natural gas sector. Most producers need natural gas prices of at least $2.50 per 1,000 cubic feet produced, if not $3, to be able to generate sustainable free cash flow. In a sign of how bad things are right now, with natural gas stuck below $2, Chesapeake Energy, Antero Resources, and Comstock Resources have all recently announced they'll be cutting their capital spending budgets this year in an effort to preserve cash. Of course, over time, lower spending will ultimately lead to lower drilling, and that leads to lower production, which could in turn lead to less cash flow and less liquidity. Leverage ratios throughout the sector have started to climb and are expected to continue to move higher throughout the year. Yet, as you can see on the slide, credit spreads are tighter today than they were a year ago when natural gas was north of $6 and producers were swimming in free cash flow. The next slide shows spreads throughout the different segments in the high yield subsectors. As you can see, as the overall markets rallied, spreads have compressed between what was the highly distressed oil field services sector and then the relatively safe haven of midstream bonds. And in fact, some sectors have inverted the spread on what is a relatively volatile high yield independent energy sector is now actually inside of the much more stable midstream segment. So when the market is so tight and there's investor, where's an investor going to go if they want to find some yield? So on the next slide here, I like to highlight some ideas that might be worth a closer look. Although I just finished talking a lot about spread compression, there are still a few bonds in the oil field services sector that might be offering some attractive yields, but just to be clear, these are not for the faint of heart. Transocean unsecured bonds are yielding more than 9%. That is the amber line there on the chart. The trade-off is that the Transocean unsecured bonds, Transocean's pretty much the only offshore driller that did not go through bankruptcy over the prior downturns, and as a result is still carrying a huge debt load. And much of that debt is secured today. So these unsecured bonds we're looking at are at the back of a pretty long line if things were to go south. However, the company's backlog has been climbing for several years and rig rates have moved up pretty dramatically. While leverage is still elevated, it may actually fall to about 5 times this year from what was closer to 8 or 9 times over the past couple of years. Neighbor's unsecured bonds offer a similar story with yield just under 10%. And that's the reddish purple line at the top. The bonds are junior to a bunch of, they don't have necessarily secured debt, but a bunch of, quote, senior priority guarantee debt. And the company is fully exposed to the stagnant North American drilling market. That said, Neighbors has continued to eke out a modest level of free cash flow over the last couple of years, and a joint venture with Saudi Aramco is well positioned to start paying dividends in the next couple of years. So both companies certainly have their challenges, but also have some reason to be optimistic. And with that, I'll hand things off to Paul Vickars, who is joining us from across the pond. Hopefully he's still awake. Paul?
All right, thanks, Spencer. You're just about awake here. It's only 8:30. Anyway, I'm Paul Vickars. I'm a senior credit analyst at BI based in London. I'm covering the integrated oil companies and some European utilities as well. Anyway, following on from Spencer's comments today, I'm going to be looking at how to identify credit value among the oil majors and how I may have to get more creative to generate alpha in an environment of tight spreads and credit stability. So the first slide, there we are, shows dollar bonds for the oil majors, and with the exception of the lower rated BP, they're all tightly clustered around the AA Industrials fair value curve, and therefore offer little scope for outperformance. Now, these oil majors can cover their capex and dividend requirements at around $40 to $50 oil, and though most of this surplus cash flow beyond that is being absorbed by share buybacks, leverage is at historic lows with plenty of headroom to mid-cycle target levels. So financial flexibility is exceptional, and credit risks are limited. Now, this is obviously recognized in spreads, as is the increasing scarcity of oil major bonds, as they have barely issued since the pandemic and continue to redeem maturing bonds in cash. However, M&A is another theme across the sector. And moving on to the next slide, sorry. That's it. M&A is a theme across the sector, and with most large deals fully stock financed and therefore at least neutral for credit quality. One way to get more creative is to look at the spread between the acquirer and the target bonds. Now, this example shows, I think it's a previous slide actually. There we go. This example shows Chevron bonds relative to Hess, the rival it agreed to acquire in October for $53 billion. Now, Chevron is rated AA minus, AA2, and is expected to assume Hess's BBB minus, Baa3 rated debt if the deal completes, which would see its ratings and the bond spreads equalized at Chevron's level. Now, the Hess 7.875 2029 bonds have moved from a spread premium of around 100 basis points before the deal to the current 50 basis points over Chevron, indicating a similar degree of tightening scope if the deal completes. Now, simplistically, this also suggests a 50% probability of completion, and this is confirmed by the equity market, where Hess's shares are at a premium of 5% relative to the announced 10% premium. There are risks that the deal doesn't complete, as it still needs regulatory and shareholder Hess shareholder approval, although we don't see this as a major obstacle. More problematic could be that Exxon is claiming preemption rights over Hess's key asset, a 30% stake in the Guyana oil project that ranks as the world's largest discovery of the past decade. Our view is that these rights wouldn't be enforceable under a corporate takeover, only if Hess sold the stake on a standalone basis, but that may be for the courts to decide. So you have 50 basis points of upside if the deal completes, and 50 basis points of downside if it doesn't. And this is the rare area of volatility opportunity in the sector. Now on to the next slide. And this shows the same concept for Exxon's agreed $59.5 billion acquisition of Pioneer. The BBB Baa1 rated 1.9% 2030 bonds from Pioneer have tightened from a premium of 50 basis points to just 15 basis points since the deal was announced. On expectation, they will be assumed by the AA minus AA2 rated Exxon. Now, this implies a 70% probability of the deal completing, which is slightly lower than the 80% implied by equity markets based on the Pioneer shares trading at a premium of 13% relative to the 16.5% announced premium. Deal risks are more limited, as it's been approved by both sets of shareholders and doesn't have any other obstacles other than regulatory approval, which we see as likely with a few concessions. So this leaves 15 basis points of upside if the deal completes and 30 basis points if it doesn't, downside that is. So less scope than Chevron and Hess, but then again, it is a lower risk proposition. Now on to the next slide, please. And this shows another way to generate yield is to move down the capital structure in a credit that you're comfortable with. And it's possible in the industrial space thanks to hybrids, which, as the name suggests, are instruments with both debt and equity characteristics. Hybrids are typically rated 2 notches below senior bonds, 1 notch to reflect their subordination, and 1 more because the coupons can be deferred. Now, if we assume that hybrids have 0 recovery in the event of default and senior bonds have a 35% recovery rate in line with Moody's long-term data, and hybrid spread should be 1.5 times senior bond spreads to compensate for this subordination. On top of this, there has to be a premium for coupon deferral risk, though this is minimal for the oil majors, as they prioritize dividends and can't defer hybrid coupons while they're paying a dividend. The other main area of risk is the option for the issuer to extend the hybrid at its first call date, rather than call and replace it, as is the market convention. Now, an issuer would only extend a hybrid if the reset spread was below the spread at which it can issue a replacement, which means the hybrid price would fall if it was extended, as rather than being called at par, it's continuing life at a below market spread. The relationship between hybrid spreads and senior bond spreads indicates there's a premium of up to 100 basis points to cover this extension risk. So if this can be understood and managed, there's scope to boost portfolio performance. Key to managing extension risk is the issuer's incentives to call a hybrid. And let's use the BP 3.25% euro hybrid as an example. The coupon on this hybrid resets at a spread of swaps plus 352 basis points in June 2026, which is well above the likely spread on a replacement of around 230 basis points based on BP's longer duration 3.65% hybrid. So there's a strong economic incentive to call it. There's also an equity incentive to call it, as the hybrid would lose the 50% equity content assigned to it by S&P if it was extended. And BP still has the need for this equity content as leverage is the highest among the oil majors. Finally, BP would be highly unlikely to risk its reputation in credit markets by extending a hybrid when investors expect it to be called. Yet BP's 3.25% hybrid offers a spread of 160 basis points, a premium of 130 basis points over its 2.213% 2026 bond, providing scope for high returns if you do your credit research and assure that it won't default, defer the coupon, or extend a hybrid. And with that, I'll hand over to the industrials team.
Thanks, Paul. Hey, everyone. So my name is Matt Geudtner, and I'm a credit analyst here with BI, who, along with my colleagues Joel Levington, Michael Doto, and Stephane Kovatchev, cover the industrial space here, with my focus primarily on A&D. So on the next slide, I think aerospace and defense should prove an outlier to the broader industrial space into next year, as the commercial aviation recovery we're experiencing is expected to sustain past mid-decade when air traffic reaches pre-pandemic levels, according to the latest IATA forecast, before sort of leveling off in the out years at more GDP-like low single-digit growth rates. And these levels compared to industry-wide passenger numbers finishing last year more than 90%, which was aided and sort of spearheaded by domestic North American activity. So with that outlook, I think there are a couple names of note within the space, and those are Boeing and Rolls-Royce. So on the next slide, you'll see the elevator pitch for Boeing's $48 billion of debt is to really deliver planes, generate cash from those aircraft, and use those proceeds to pay down debt. Whittling down inventoried planes while progressing towards the recently FAA imposed cap of 38 737s a month in 2H of this year should support steady cash flow generation in 2024 relative to last year. And that would replenish balance sheet cash into year end after Boeing paid off a majority of their 2024 maturities, and after absorbing free cash flow burn here during the first quarter. And so I think that would set them up with growing excess liquidity available to execute more meaningful liability management through mid-decade in order to keep pace with rater assumptions, and could be a catalyst for spread tightening relative to peers. We saw the short end of Boeing's curve move widest relative to levels seen prior to Alaska Airlines flight incident in January, which pushed spreads out. Boeing's 4.875s, the 2196s and 515s through the belly of the curve trade almost 30 basis points wider. So I think that could be a potential opportunity, though I know bondholders remain exposed to event risk. But a deal for Spirit Aerosystems, as confirmed last Friday, following a string of quality lapses that culminated in a door plug blowout, could temper the sort of episodic spread widening that bondholders have endured with the duopoly and the very large as well as long backlog that they have sort of will continue to anchor the OEM's credit profile. And on the next slide for Rolls-Royce, we think they have cemented their status as a rising star, which is an outcome that we think is achievable over the next year or so, and a potential catalyst to close the over 30 basis point discount at which its BA1 BB plus rated US dollar and sterling denominated bonds trade relative to investment grade peers. Commercial aerospace should be a key driver for free cash flow advancing to 1.7 billion pounds or more this year, and surpassing rater thresholds for a potential crossover. They're pulling levers available to them in order to deleverage by paying down the debt that's due in 2024 and 2025 rather than refinancing, which may drive a full turn of deleveraging. And so paying down over £1 billion worth of debt as the top line is growing, thanks to civil aerospace, should put the engine maker exceeding thresholds for upgrade, which include adjusted net leverage for S&P, margins for Fitch's stated sensitivities at BB+, with leverage and cash flow coverage metrics that are screening at ranges comparable to Moody's BBB bucket under their aerospace and defense sector methodology. And you can see those FIWs on the next slide. You have the FIW on the top end for the US dollar denominated bonds. It's bifurcated by BB tier versus BBB tier industrials, and the lower is the sterling denominated notes. And so I'm going to pass it over to my colleague, Mike Doto, who is going to take you through the broader industrial base and his views on the sector for the year.
Thanks, Matt. Yeah, so my name is Michael Doto, and I help cover the diversified industrials along with Joel Levington, who's not here today. So within the diversified industrials, M&A has been near like decade lows as high interest rates and elevated premiums have pushed a lot of the capital away from deals. We have seen some larger deals go through, like Emerson's purchase of National Instruments, and most recently, Honeywell's purchase of Access Global from Carrier. But we do expect a rebound this year as debt capacity across the sector has grown and balance sheets remain fairly healthy, I would say. So while rates are staying higher for longer, they will get cut and premiums should start to come down. On top of that, we may start to see slowing growth, so companies may start to look to supplement that, and I'll talk about that a little bit later on. So the graphs here show relative debt capacity across the sector, Honeywell remaining near the top even after its $5 billion acquisition. So they could even pursue a deal upwards of $20 billion if they wanted to. And then we have companies like Fortive, Eaton, who also have large debt capacity and have pursued aggressive M&A in the past. So we think something could be done. Another big part of it has been asset sales, which have remained fairly active over the past year. We think that could continue with companies like Dover, Honeywell, 3M, Johnson Controls. They all have units that we think could be separated. Johnson Controls even just recently announced a consideration for selling their HVAC assets. Next slide, please. Now, across the sector, we do recognize from a bigger picture that fundamentals are weakening across the board with organic growth declines 5 of the past 6 quarters. This could be a potential sign of a recession, which would align with a PMI that's been in contractionary territory for around like 16 months now. With that, I mean, we still expect modest growth in the sector and margins, which are very supportive of strong cash generation. Next slide. So while not our base case, we looked at incremental leverage companies could expect in both a soft and hard recession scenario, which we view would between like 5 and 10% declines in revenue. So those fairly healthy balance sheets and the limited M&A I talked about before has positioned the sector fairly well with only modest increases in leverage across the board. Next slide. However, we do have some names like the Vontiers, Allegiant, and the Regal Rexnord, which all face large leverage spikes, which would threaten current ratings. So while the upper end of the spectrum with Otis, Eaton, Honeywell show little risk in either scenario. Next slide. Now, with evaluations, we're fairly balanced across the sector. I'm just going to go through a couple of the names here. So starting with 3M, who's been dealing with legal overhangs. While some of the uncertainty has played out, additional downgrades and the potential for a large dividend cut are still not really priced into bonds, so that could have a large effect going into this year and next. GE, which is transitioning into an aerospace pure play, will reframe how it's being viewed. You saw some movement in their CDS swaps, but we still think there's some more room to incorporate that change. Parker Hannifin we like. They continue to do well fundamentally, and the potential to pay down over $2 billion in debt gives them a pretty clear path to single A ratings. And with bonds still not pricing that in until the back half of the year or even further out, we think there's some room there. Then we like both of the Danaher spinoffs just for different reasons. So starting with Veralto, went public with bonds wider than we initially anticipated. But as a mid triple B with defensive characteristics, if we do get those recession scenarios that we talked about, they would outperform in a case like that. Then with Vontier, which trades the widest in our coverage, has little chance of falling out of IG, already is committed to almost 25% of their cash generation for debt reduction. So with bonds trading wide of some junk names, we think that they could tighten over the next year. And then finally, with names like Johnson Controls, Eaton, and even Otis, they're all fundamentally sound, just no real relative value there. So we want to stay away from those, especially with a case like Johnson Controls, with their uncertainty around an asset sale. We kind of view that as a negative credit event. So with that, I'll now pass it to Stephane to talk about the European side of the industrials.
Thank you, Mike. Hello, everyone. My name is Stephane, and I cover European industrial credits. The key message for me tonight is that European outlook is much more gloomy than that of the US. For instance, European GDP is expected to grow at about 0.5% this year compared to 2% growth in the US. Unemployment levels in Europe are also nearly double the unemployment rates in the US. And also the probability of recession here in Europe stands at about 60% in the next 12 months, according to Bloomberg Consensus. Now, in this environment, the first question I like to ask myself is, are the fundamental risks reflected or not in the cyclical industrial sector that I follow? To answer this question, I like looking at the yield to worst of the industrial sector, as you can see on the slide. What is interesting here is that capital goods credits have performed worse than the broader index in 23 and also worse year to date. On top of this, the average yield is about 30 basis points lower than the wider index. So the broader and more diversified credit index has performed better and also yields more currently. This tells me that the relative outperformance of European industrial credits this year may be easier said than done. With this in mind, moving on to the next slide, I just wanted to briefly discuss my favorite forward-looking indicator, container shipping freight rates. In other words, the cost of moving a container from Asia to Europe or Asia to the US. A demand for container shipping services is closely correlated to GDP growth. So when container shipping companies are warning about deteriorating fundamentals, this is often reflected in softer GDP trends with about a 6-month lag. So there's good news and there's bad news here. The bad news is that the sector is guiding for a very weak 2024. The good news is that the reason for this weakness is not demand, at least not yet, but more the supply of container ships. So during the pandemic, a lot of new ships were ordered, and since it takes 2 to 3 years to build a container ship, a lot of the ships are being delivered this year. So overall, freight rates should soften in the coming months, which is good news actually for all of us, as it should help reduce inflation this year. That said, it's also bad news for companies in the sector. So lastly, on the next slide, 3 quick points on some of the companies in my coverage. Number one, truck manufacturing companies such as Volvo and Daimler Truck could be exposed to softening fundamentals this year, with revenue and EBITDA dropping by about 10 to 20% in 24. So these companies also have finance arms with a lot of short-term debt outstanding. So they are very much exposed to higher interest rates, especially now as fewer rate cuts are expected by the market. Number two, container shipping fundamentals are deteriorating and may hit players such as Maersk and Hapag-Lloyd this year, which may be very interesting names to watch. And number three, geographical and product diversification may be key for bond performance this year. What I mean is that companies generating revenues internationally, such as Abertis and WeBuild, that you can see in the bottom right of the slide, may be better positioned to weather the recession risks ahead. With this, I'll stop here and hand it over to my colleague Steve Flynn to discuss TMT credits.
Great, thank you, Stephane. My name is Steve Flynn. I cover communications, both investment grade and high yield. Let's start out with IG communications. So what you can see here is the Bloomberg High Grade Index broken up by sector. And you can see that communications is one of the widest trading sectors. Now, part of that is due to the fact that the sector does have a lot of long dated bonds. And so those trade at higher spreads. That's obviously one reason. A second big reason is that there's a lot of changes going on in the cable media landscape, the way people view video, and that has pushed a lot of the more speculative credits wider. Thinking about the mix of long-dated credits, communications accounts for 8.35% of the overall index. But if we were able to run this screen with bonds that have a duration of more than 10 years, you'll see that communications accounts for about 13.5% of those bonds. So again, a much bigger weighting towards long-dated bonds. Year to date, the sector is one of the worst performing in IG, with a total return of negative 1.9% and an excess return of minus 24 basis points. That compares to the overall IG index that has a total return of just a little slightly negative 0.9%, and excess return positive 28 basis points. So the sector is clearly lagging. The good news is that some of the largest names have stable or improving credit profiles. So if we think about AT&T and Verizon, each of those companies are striving to improve their leverage ratios over the next couple of years. Think about other large names such as Comcast and T-Mobile US. They're in line with their leverage targets and expect to stay there. Next slide, please. So let's think about where the weaknesses in communications. These are IG Communications BBB rated credits with spreads. And you can see that two of the widest names are Paramount and Charter. That includes Charter. These are Charter secured bonds and includes bonds that are issued by the Time Warner Cable subsidiary with the TWC ticker. Let's talk about a little reason why. Number one, if we dig into Paramount, Paramount, number one, has elevated leverage. Let's stay on that slide. Yes, Paramount has elevated leverage at about 5 times or almost 5 times. And the company is exposed to the weakest parts of the media landscape with about 2/3 of the company's revenue coming from the linear TV business, which is under a lot of pressure from a shift from linear to streaming. Now, Paramount does have good liquidity. They have a lot of cash on hand, very moderate near-term maturities. They've been selling assets, and deleveraging is the company's top priority, and they expect to improve the credit profile this year. They expect earnings to grow, higher free cash flow, and they could seek to sell additional non-core assets to repay debt. So, which is all good, but the problem is leverage remains high. Now, the company is rated low BBB across the board, Baa3, BBB minus, BBB minus. And they could lose one of those IG ratings soon, as S&P recently placed its BBB minus ranking on review for potential downgrade to high yield. So we could see something in the next few weeks there. Fitch just yesterday downgraded from mid BBB to low BBB with a negative outlook, and looks like they have about a 12 to 18 month window to show that they are making progress in reducing the leverage towards Fitch's threshold for the rating. Now, one wild card here is that Paramount and its controlling shareholder National Amusements have been the subject of many M&A reports over the past couple of months. So there's a potential for a deal to happening and a meaningful change to its risk profile. So let's keep tuned there. Now, Charter is the other really wide name here. Charter bonds, the secured bonds are rated Ba1, BBB minus, BBB minus, so they stay in the IG index due to the 2 BBB minuses from S&P and Fitch. Now listen, it is vital for this company to maintain IG ratings from S&P and Fitch for its secured obligations, given the massive size of Charter's debt load. Charter's total debt is about $98 billion. 72% are secured bonds and loans with high-grade ratings, while the remaining 28% is high yield rated unsecured notes. Now, why do bonds trade so wide? A couple things. Number one, investors are concerned about changes in the cable TV viewing landscape as people are shifting away from cable packages to streaming. Charter has a willingness to maintain net leverage at the high end of its target range. There's a potential for Congress to not extend the ACP or Affordable Connectivity Program, which is a broadband internet subsidy for low-income Americans. And Charter by far has the most subscribers on this program, so that's a risk. And there's a potential for only modest free cash flow this year as Charter is spending a lot on network investments. Finally, what pushed the bonds even wider recently is that there was a Bloomberg report on February 26th that Charter was considering an acquisition of Altice USA, which is a leveraged cable company. We think Charter could have the opportunity to acquire them and maintain the IG ratings for secured from S&P and Fitch. This is crucial. Pro forma leverage, if you combine the two companies, is about 4.8 times, and S&P and Fitch have each talked about 5 times as a potential trigger for lower ratings. So that's something to watch going forward. Next slide, please. Just to hit high yield. So communications is by far the widest trading sector in high yield, as you can see here. There's a few reasons. Number one, increased competition with broadband between cable, fiber, fixed wireless access being provided by the wireless companies, the changing video consumption landscape that we talked about. And you have a lot of large challenged capital structures. The biggest stress name so far is EchoStar and Dish, DBS Securities. That's one to watch. Dish most likely will have a near-term liquidity need. EchoStar has, on a consolidated basis, about $2.4 billion of cash at the end of 23. yet they face larger obligations this year between a buyout of minority subsidiary, a $1 billion convert maturity on March 15th, a $2 billion Dish bond maturity on November 15th, and likely free cash flow deficit this year. I look for EchoStar and Dish to do something to boost its liquidity in the near future. With that, I'll turn it over to Rob to handle technology. Thank you.
Thanks, Steve. We're going to finish it on the strongest note possible. And no, that's not me. It's the tech space. Opposite of what Steve just went over, tech is the tightest within the investment grade index. And it's been that way for a while. I think if you look at this space relative to its entire credit history, credit quality has never been better. The amount of financial flexibility, cash flow, excess balance sheet firepower, and potential for long-term growth has never been better. And it shows up on spreads and performance. If you look at excess returns year to date, we're slightly lagging the index average. That's what's going to happen. When you have the best, tightest names in a spread tightening environment, you're going to mildly or maybe significantly underperform. In this case, it's a mild underperformance. However, if you were thinking that there was going to be much more increased volatility, or we're going to be heading into a hard landing, this would be a place to park your money. There's a lot of different ways to show this, and my teammates often laugh because I mention cash nonstop. Part of the reason I do that is because credit analysts, cash is king. And by far, technology, cash is king. It doesn't really matter if you're looking at the sector leader, Apple. It's just got so much cash, it's almost silly, $173 billion of cash. But if you look all across the board, you could choose any high grade name, whether it's in AAA, AA, or BBB, and generally you're going to be talking about sitting on 5, 10, 15, $20 billion of cash. And the beauty is that free cash flow is growing at such a strong rate that we don't see financial flexibility declining, even as M&A picks up. Remember last year we saw an $80 billion transaction close, Broadcom buying VMware, half financed with cash. Broadcom was upgraded. Microsoft bought Activision for $70 billion of cash. They didn't borrow a dime. They didn't lose their AAA. I think you're going to see continued M&A. You've seen that this year so far with Cisco Splunk. You're seeing it with HPE and Juniper, Ansys, Synopsys. Deals are going to get bigger because equities are rising, and that there's a tremendous amount of ability to borrow additional funds without losing credit quality. One of the additional ways that companies are going to be spending their money is through buybacks. And the reality is that you're not going to worry about spreads going wider or credit going lower because of large buybacks or increased shareholder returns. The reason is because there's so much excess cash flow, rather than having sit on the balance sheet, it's being paid out. There are certain names whose cash flow is going up so fast, they're going to have no alternatives but to buy back stock. If you look at, remember when I started out, I said that we have a legal group. Our litigation team basically tells me that any of the Mag 7 really have little to no chance to getting any deal done. The regulatory headwinds that exist for Apple, Amazon, Meta, Alphabet are probably just too large within this administration, and it means you're going to see bigger and bigger buybacks. Names like NVIDIA, that obviously lead the AI craze, are going to see cash grow so quickly. The alternatives are few and far between. NVIDIA was just upgraded to AA, and I think they're going to end up doubling their buyback from 25 billion to 50 billion within the next year, and rating agencies don't seem to care. It just goes to show that you can shoot a lot of arrows at this tech space, but most of them are going to bounce right off. And one of the things that we think about a lot in terms of at least creating more opportunities to find entry points is looking at refinancing. The last couple of years, issuance has been meaningfully below historical levels. The historical decade average has been in and around 100 billion, but we've seen numbers about half of that for the last few years. One is, pre-COVID, we had a lot of pre-financing with rates as low as they were. And then post-COVID, with rates rising, companies were able to self-finance. I think some of that's going to be changing, particularly as we see more and more rate cuts start to hit the tape. Again, I think that creates opportunity. New issue concessions have not been that large, but in this space, when a company does a deal, they're not issuing 500 million or 750 million or a billion. They're doing 3 billion, 5 billion, 10 billion in the case of Cisco, 13 billion. I think there's going to be more of those jumbo type deals. And though you might not get 20 or 25 beeps concession, you can get 5 or 10. And in a spread environment where the IG index is below 100, those type of concessions can still make a difference to help excess returns at least stay in line with alternatives in a spread compressing environment. I cover a lot of names across hardware, software, semis, social media. Quite frankly, I could argue that almost everything should be green, but the way that we do things here is that we're thinking about valuation on an intra-sector basis. So if I have to own a name in tech, which ones do I want to own and why? In general, I think there's a few names that trade meaningfully wider, and that's on a relative basis, than what their credit quality suggests. If you look at the first two names on this list, Alibaba and Apple, Alibaba trades almost 100 beeps wide out the curve relative to some US peers. I know there's a whole host of reasons why people are concerned about China risk, but when you're sitting on $92 billion of cash and you generate $20 to $30 billion of free cash flow every year, there's a huge cushion if anything were to go wrong, i.e. your stock falls by 50% and spreads don't go wider. In fact, we've seen Alibaba spreads do nothing but rally over the last 12 months, and they're getting closer to industry peers. But still, whether you're picking in the belly of the curve or the front of the curve, picking 50 or 75 basis points from an excess return basis, Alibaba has far outperformed relative to others over the last 3 months. Apple, which now has a AAA on one side, how could that possibly be relative value, particularly when they continue to pump new bonds into the market? Well, it's sort of the reverse of how much cash they have. Yeah, they've got a ton of cash, but they also have $108 billion of debt outstanding. Everyone's full on the name. It doesn't mean that there's not more room to add, but there's bonds all the way out the curve. When Steve mentioned in his space that there was a much higher duration in communications, the same could be held for tech. But when you have $108 billion of debt, it means you have 5, 7, 8, $10 billion of debt maturing every single year. When you look into the triple B space, the names we like are Broadcom and Oracle. I think they trade too wide to triple B peers. In the case of Broadcom, I think numbers are going to just keep getting better and better. And in the case of Oracle, I think they just sold off a little bit too far, too fast. When we start thinking about names that we don't like, we look at names that are not generating positive free cash flow. It might be temporary. For some, it might be secular. For others, from a high quality perspective, it's Intel. From a lower quality perspective, it's names like Seagate, and Xerox that just have massive secular headwinds, as well as some cyclical headwinds that I don't think that they can get over. Listen, we covered a tremendous amount of material today with a lot of people from a lot of different regions, but I do want to emphasize that everyone on this team is always eager to speak to you. If you don't know how to reach us, at least here are emails. We're all happy to give out our phone numbers as well. If you're on the terminal, you can just send us an IB anytime. But we're here for your needs, and we sometimes get our best ideas from conversations and people questioning what we're doing. So please, again, don't ever hesitate. And I really want to thank Fiazi and Ralph for having and hosting the team. It's a pleasure and an honor to participate with you guys each year. I'll turn it back to Ralph.
Ralph is not on the call anymore. He's on as an attendee. So I'm going to say thank you to all of you and look forward to doing this again next year. Have a good day, everyone.